What if the thing being devalued is not your portfolio, not your house, not your salary, but the ruler you are using to measure all of them? That is the question most people never ask until it is much too late. They wake up one day and say groceries feel higher, rent feels higher, insurance feels higher, travel feels absurd, school, energy, repairs, labor, food. Everything feels heavier. They assume the world became more expensive in some abstract way and move on. But when enough things rise together, and they rise year after year while the official language remains oddly calm, the real issue is often simpler and more brutal. The measuring stick itself is shrinking. I want to begin there because until you understand that point, almost everything else in this conversation looks like noise. Gold looks like a speculative side story. Bank research looks like elite trivia. Central bank behavior looks distant. Hedge fund liquidations look technical. Insurance allocations in China look obscure. The dollar looks permanent because it has been around you all your life. Cash in a savings account feels prudent because it sits still and stillness feels safe. But stillness inside a shrinking measuring stick is not safety. It is silent loss. That is the first rule. The most dangerous reset in finance is the one that changes the value of the unit while most people are still staring at the objects priced in that unit. Once you see that, the whole picture changes. You stop asking only whether stocks are up or down. You stop asking only whether gold had a good month or a bad month. You stop asking only whether bonds yield more than they used to. You stop asking only whether your savings account pays 4%. And you start asking the question that actually matters. What is happening to the purchasing power of the thing in which I am storing my life? That question is not glamorous. It is not the kind of question that turns ordinary people into internet legends at dinner parties. It will not make you sound futuristic. It will not earn you admiration from the kind of crowd that loves whatever went up most recently. But it is the kind of question that separates the people who merely hold assets from the people who understand what those assets are defending them against. I have spent my life around people who think in nominal terms. They look at a salary and see a number. They look at a house price and see a number. They look at a portfolio statement and see a number. They look at a savings account and see a number. Then they compare numbers to older numbers and congratulate or depress themselves accordingly. That is not serious financial thinking. Serious financial thinking begins when you understand that a number by itself has no meaning. A number only matters relative to what it can command in the real world. If the command power is decaying, then apparent stability is often only disguised erosion. That is the second rule. Money that stands still can still be losing a race you forgot to measure. Now, I want to give you the single mother line for this whole story. I call it the melting ruler. Everything we are about to talk about hangs off that one image. A ruler is supposed to be stable. You use it because you believe an inch today is an inch tomorrow. The moment the ruler itself begins changing length, measurement becomes deceptive. You can still calculate, you can still compare, you can still sound intelligent. But all your results are contaminated because the measuring device is unstable. Cash is like that in an inflationary age. The average saver imagines cash as neutral. Neutral means harmless. Neutral means resting. Neutral means wait here until the world makes sense again. But if the ruler is melting, waiting in cash is not neutral. It is a choice to remain loyal to a shrinking unit. Sometimes that is still the least bad choice for a while. Liquidity matters. Dry powder matters. Optionality matters. I have held mountains of cash in my life, and I would do it again when conditions demanded it, but I never confuse cash with permanent safety. Cash is tactical shelter, not long-term refuge. When the measuring stick itself is under pressure, that is why I pay such close attention to what the largest institutions in the world are doing when they do not have the luxury of being sentimental words. Matter less to me than custody. People say many things in public. Institutions hold fewer illusions when real reserves are moving. If the world's central banks are reducing exposure to one reserve instrument and increasing exposure to another asset that cannot be printed, that deserves my attention. If major investment banks are writing notes to their most important clients, saying the long-term case remains constructive for the same hard asset after a sharp decline, that deserves my attention. If the most populous country in the world begins widening institutional channels into that same asset, that deserves my attention. If at the exact same moment ordinary investors are sitting in cash, hoping the confusion passes, then I know exactly where the asymmetry lies. The smart money is not emotional about the object. It is defensive about the ruler. That is the first mechanism I want to name. I call it reserve migration. Reserve migration is what happens when serious institutions begin moving away from promises and toward collateral they trust more under strain. It does not have to happen all at once to matter. In fact, it almost never does. The great financial shifts of history rarely arrive with a trumpet. They arrive as reweighting, a little less of this, a little more of that. One policy change here, one reserve adjustment there, one allocation note from a bank, one insurance rule change, one central bank purchase, one quiet shift in what sophisticated people prefer to hold when they are less sure of the future. than the headlines imply. That is exactly the kind of change most ordinary people miss. They miss it because the world teaches them to notice excitement, not drift. They notice a stock doubling. They notice a coin collapsing. They notice a housing frenzy. They notice a charismatic prediction. They do not notice steady reserve migration because reserve migration is bureaucratic. It happens inside balance sheets. It looks boring until it has already changed the landscape. I have never underestimated boring balance sheet decisions. Boring decisions move worlds. Let me show you the second mechanism because this is where many people get badly confused. Gold or any hard monetary asset can fall sharply in the middle of a bigger bullish regime and still remain fundamentally strong. Most people cannot emotionally process that. They see a 12% drop and imagine a broken story. That is because they are still looking only at the surface of price and not at the plumbing underneath. When a deep liquidity squeeze hits large funds, those funds do not sell what they hate. They sell what they can. Liquidity squeezes reorder the logic of selling. The issue is not, what do I most want to get rid of? The issue is, what can I liquidate quickly enough to satisfy pressure elsewhere? That is what happened so often in the past, and it is why I do not panic when the most liquid winners get sold during multi-asset stress. In a real squeeze, gold can get sold not because people stop trusting it, but because they trust that it can be sold quickly. That distinction matters. I call this the winner liquidation trap. The winner liquidation trap is when people mistake forced selling of a liquid asset for a genuine collapse in the underlying reason that asset was owned. The reasons the asset was attractive may still be standing there untouched. Inflation pressure may still be there. Currency stress may still be there. Geopolitical risk may still be there. Reserve migration may still be there. Rate cut expectations may still be there. The asset gets marked down anyway because someone somewhere needed dollars today. This is a very important adult lesson in markets. Price does not always tell you what was judged worthless. Sometimes price only tells you what was easy to reach. If a hedge fund is losing money in levered equity books, in rates, in currencies, in credit, and in every other place where panic is spreading, it does not hold a philosophical debate with itself before selling. It reaches for the liquid object on the shelf and converts it into cash. In such periods, a good asset is not protected by being good. It is punished for being saleable. That is why I distrust simple narratives during forced deleveraging. Simple narratives make people poor because they offer emotional clarity precisely when structural thinking is required. Now let me bring in the third mechanism, because it sits at the heart of why I think the long-term case remains more important than the short-term drawdown. I call it the boss bank signal. You can call them central banks if you like, but I want you to think of them in the bluntest possible way. They are the institutions sitting closest to the power to create and destroy currency conditions. They see reserve fragility before the public does. They understand that political promises and sovereign debt arithmetic do not always walk in harmony forever. And when these institutions steadily accumulate a hard asset that nobody can print while publicly still participating in the existing fiat system, I pay attention. Not because they are moral, because they are close to the plumbing, and the closer you are to the plumbing, the less likely you are to confuse a decorative faucet with the state of the pipes. If emerging market central banks are increasing the share of reserves held in gold or other hard assets relative to traditional reserve claims, they are sending a message. The message is not necessarily that the system breaks tomorrow. The message is that trust is being diversified. That is a very different thing, and in some ways more important. Systems usually break only after trust has been diversifying for years. The clever person waiting for the headline, "The old system is dead," will be the last man through the door. The patient allocator watches trust migration instead. Now I want to say something uncomfortable about savings accounts because too many people treat them like moral virtue instead of financial instruments. A savings account paying 4% in a world where the real cost of living is rising faster than that is not a fortress. It is a slowly leaking raft, better than no raft. Yes, better than reckless speculation. Yes, useful for short-term liquidity. Yes, but if you sit on that raft for years believing you are preserving wealth while the ruler melts faster than the account grows, you are confusing nominal comfort with real preservation. That is the fourth rule. Earning interest is not the same thing as keeping up. People love percentages because percentages sound objective. I am getting 4%. I am getting 5%. My bank pays something. Fine. What matters is not the percentage alone. What matters is what the percentage is defending against. If food, housing, insurance, education, travel, energy, maintenance, services, and taxes rise faster in lived reality than the coupon you are collecting, then your sense of prudence may simply be the emotional pleasure of losing slowly. That is not the same as safety. This is where the fourth mechanism arrives. I call it the silent dilution engine. The silent dilution engine is the process by which governments' deficits, debt issuance, monetary accommodation, And persistent inflation pressures reduce the purchasing power of the currency, while ordinary savers remain fixated on nominal balances. It is one of the most politically convenient machines ever invented because it does not seize wealth in one dramatic act. It dilutes it over time while people argue about everything except the measuring stick. That is why I'm so skeptical whenever I hear soothing language about deficits being manageable forever, rates being normal forever, or spending never needing true discipline. The arithmetic eventually arrives. You cannot keep expanding obligations, increasing issuance, and imagining the currency somehow remains morally untouched by the process. Something must absorb the strain. Sometimes it is bondholders, sometimes it is taxpayers, sometimes it is future growth. Often it is the quiet purchasing power of cash. And people only notice after enough years accumulate that the same life costs much more than they remember, while their safe money did almost nothing to resist it. I have always liked businesses that cannot easily be debased because they are tied to real output, real need, or hard to replicate economics, and I have always understood why a rational slice of serious wealth, especially in uncertain monetary periods, often seeks some form of refuge in assets that do not depend on a politician's discipline or a central banker's future good behavior. That does not mean I worship gold. It means I understand what problem gold is trying to solve. That distinction matters. People get into trouble when they turn a defensive asset into a religion. I have no interest in religions of finance. What I want is function. What job is this asset doing in the portfolio? What is it protecting against? What can it not do? What is the cost of holding it? What is the liquidity profile? What does it correlate with under stress? What would make the thesis less compelling? Those are adult questions. The crowd rarely asks adult questions. The crowd asks whether the asset is hot. Now let me address the elephant in the room. Yes, gold can be volatile. Yes, it can go nowhere for stretches. Yes, it does not produce cash flow in the way an operating business does. Yes, it can be mistimed badly. Yes, it can disappoint people who want every asset to flatter them every quarter. I know all of that. But a fire extinguisher is not judged by its yield during years when the kitchen stays calm. It is judged by whether it solves the problem it was owned for when flames actually appear. This is how you should think about defensive hard assets, not as magical return generators, as strategic counterweights to monetary carelessness, geopolitical instability, and reserve distrust. That is why the fifth mechanism matters so much. I call it strategic ballast. A ship crossing rough water does not want every piece of its structure to be optimized for speed and calm seas. It wants ballast, it wants weight arranged in such a way that the vessel is harder to flip when the weather changes. Ballast can feel unexciting in sunshine. That is exactly the point. You do not own ballast to entertain yourself. You own it to avoid capsizing. For some investors, gold, short-term sovereign debt, strong cash positions, select real assets, and certain defensive businesses serve this role in different proportions at different times. Not forever, not dogmatically, strategically. That word matters. Strategy means context. Now, I want to talk about why the crowd so often gets this wrong. Because if you can understand the crowd's error, you can stop imitating it. The crowd loves simple emotional stories. If an asset rises, the crowd calls it obvious in hindsight. If it falls, the crowd calls it broken. If institutions sell, the crowd assumes the institutions know something permanent. If institutions buy, the crowd wants to know if it is too late. This is childish behavior dressed as investing. Real investing begins when you can separate three different questions that the crowd collapses into one. Why did it move? Who was forced to move it? What changed in the long-term structure, if anything? Those are different questions. The crowd treats them as one question because that is emotionally easier. If you tell me gold fell, that tells me almost nothing by itself. If you tell me leveraged funds needed cash and liquidated winners in a broad risk event, that tells me something. If you tell me central banks are still accumulating, large banks remain constructive. Insurance channels are opening in giant economies. The dollar faces structural pressure, and inflationary or stagflationary conditions remain plausible. That tells me something else entirely. Price is one piece of information, structure is another. Sophisticated people make money by learning not to confuse the two. That brings me to the sixth mechanism. I call it structural alignment. Structural alignment is when short-term chaos temporarily obscures, but does not reverse the larger forces driving an asset or an allocation trend. If your short-term move and your long-term structure are in conflict, the interesting question is not which headline should I believe. The interesting question is which force is more durable. I care much more about durable forces. Durable forces include reserve diversification. Durable forces include deficit financing and debt accumulation. Durable forces include geopolitical fragmentation. Durable forces include insurance and pension rules opening new channels for flows. Durable forces include real rates falling relative to inflation pressure. Durable forces include a diminishing willingness among many countries to rely too heavily on dollar exposure alone. These are not one-week stories. These are long arcs, which is why I think this moment is much less about should you chase gold after a dip than about do you understand the reset that is already underway in the way institutions think about storing value. That is the real story. Not a shiny medal, a changing answer to the question, what do serious people trust when trust in the measuring stick weakens? Now let me deal with the dollar directly because people get emotional about reserve currencies in a way that is almost religious. They grew up inside the system, so they assume the system must always be centered. The same way I do not believe in eternal monetary privilege. I believe in long periods of habit, then gradual repositioning, then lagging recognition. The dollar does not need to collapse tomorrow for dollar holders to experience quiet long-term impairment. It only needs to lose a little trust at the margin, year after year, while policymakers continue behaving as though deficits, issuance, and devaluation can all be absorbed without consequence. That is how empires of purchasing power lose their aura. Not always in a single fall, sometimes in a long surrender. That is why I tell ordinary people to stop imagining that doing nothing is neutral. In an age of monetary strain, doing nothing is often a position. Holding too much cash for too long is a view. Remaining entirely dependent on one measuring stick is a view. Refusing to study where smart institutions are quietly repositioning is a view. And every one of those views has a cost. The seventh mechanism is what I call passivity tax. Passivity tax is the hidden loss paid by people who assume that because they did not actively make a risky decision, they also did not make a meaningful decision at all. But in finance, the refusal to allocate is still an allocation. The refusal to hedge is still a hedge choice. The refusal to diversify your defense is still a strategic statement. I will wait sounds calm, but if the thing you are waiting in is being diluted faster than you admit, then wait is not a harmless verb. It is a negative real return wearing a polite face. This is why I keep returning to simple frameworks. People think professionals survive because they have access to more complexity. What often saves them is not complexity. It is sequence. They ask 3 questions in order. What are the smartest institutions actually doing with custody? Not just words. What is the crowd doing emotionally? What is the long-term structural force likely to outlast the current panic or complacency? If you ask those 3 questions with discipline, you will start seeing the world differently. You will notice when central banks are buying while retail is sleeping. You will notice when banks are constructive while news headlines are still fixated on the recent drawdown. You will notice when the crowd is selling because it needs relief, not because the thesis broke. You will notice when a short-term squeeze creates a price the long-term story does not justify. You will notice when your own emotional relationship to cash is less about analysis and more about the comfort of stillness. Those are valuable observations, and they do not require a PhD. They require honesty. Now let me be very practical. I am not telling you to put all your wealth into one hard asset. I do not believe in single asset salvation. That is another childish instinct. I believe in rational layers, liquidity for near-term life, productive businesses for long-term compounding, strategic ballast for monetary and geopolitical stress, some optionality, some defense, some offense, some humility. Humility matters, especially now. Because whenever a great reset begins in wealth storage and reserve thinking, the most dangerous attitude is certainty. You do not need certainty here. You need awareness and proportion. You need to know that cash alone is not enough. You need to know that long-duration claims can suffer when the ruler itself is under scrutiny. You need to know that hard assets have a role even when they are inconvenient and unexciting. You need to know that institutions often reveal more through reserve behavior than through television commentary. You need to know that sharp declines in good defensive assets can be created by liquidity stress without invalidating the larger case. You need to know that your own life is being repriced every year, regardless of how calm your bank app looks. That is the 8th mechanism. I call it real-life repricing. Real-life repricing is the process by which the lived cost of existence moves faster than the official stories many people use to reassure themselves. Hotels, food, education, transport, labor repairs, insurance, experiences, everything gets remarked in actual life long before some summary number fully captures the emotional truth of it. People laugh about the old price of a vacation or a restaurant or a room or a service and call it inflation casually. They should take it more seriously. That casual laughter is the sound of a shrinking ruler being normalized, and normalization is what allows silent loss to continue unchallenged. I want to talk about psychology for a moment because no financial framework survives if your psychology collapses the moment volatility appears. The biggest reason people lose in these transitions is not lack of intelligence. It is misplaced emotional loyalty. They feel loyal to cash because cash is calm. They feel suspicious of hard assets because hard assets move. They feel safer in the familiar measuring stick, even when the measuring stick is what is being shaved down. That is understandable. It is also costly. Adults have to grow out of needing their protection to feel emotionally comfortable all the time. Sometimes the most useful protection looks ugly in the short term. Sometimes it drops right when you thought it should defend you. Sometimes it forces you to understand plumbing, not slogans. Sometimes it requires that you tolerate discomfort while the long-term thesis stays intact. That is true of many good decisions in life. The ninth mechanism is discomfort asymmetry. Discomfort asymmetry is when the thing that protects you over a long horizon feels worse in the moment than the thing that slowly harms you. Cash feels calm. The hard asset feels volatile. But calm and safe are not synonyms. The slow leak often feels better than the occasional jolt, right until enough years pass that the leak becomes obvious. This is one reason so few people preserve wealth well across monetary resets. They optimize for emotional smoothness instead of structural defense. I have never trusted emotional smoothness as a serious criterion. I trust function. If I were explaining this whole environment to a young investor in one sentence, I would say it this way. Your job is not to worship gold. Your job is to stop worshiping the melting ruler. That is the whole point. Now, let me give you the operating system I would use. First, define what percentage of your life must remain in true liquidity because you may need it soon. Do not romanticize illiquidity. Bills matter. Emergencies matter. Opportunity matters. Cash still has a purpose. Second, define what part of your wealth is meant to compound through productive enterprise. Good businesses bought at sane prices still matter enormously. I have never abandoned that principle. Third, define what part of your wealth exists specifically to defend against reserve distrust, inflation persistence, geopolitical stress, and dilution of the measuring stick. Be honest about that job. That is strategic ballast, not entertainment. Fourth, study custody. Not chatter. What are central banks doing? What are major institutions doing? What new channels are opening? What reserve behavior is changing? Fifth, whenever a sharp sell-off occurs in an asset you own, for structural reasons, ask whether the structure changed or whether the holders simply needed cash faster than they needed logic. Sixth, stop confusing nominal return with real defense. Seventh, never make a portfolio decision because a short-term move embarrassed your ego. This last point matters more than people admit. A hard asset dropping after you bought it can feel like a personal humiliation if your ego was wrapped around being right. That is precisely the wrong relationship to have with ballast. Ballast exists to serve function over time. It is not there to flatter you. Now, I want to bring this together with one final identity shift. Most people think like tourists in finance. They ask what is hot, what moved, what fell, what should I buy, what should I sell, what is the trade, what is the headline, what is the call. I want you to think like a reserve manager. That is the flip tourist to reserve manager. A tourist looks at the scenery. A reserve manager thinks about survival of purchasing power. A tourist asks whether an asset is exciting. A reserve manager asks what problem the asset solves. A tourist reacts to price. A reserve manager studies flows, custody, trust, dilution, and structure. A tourist wants to sound current. A reserve manager wants to remain solvent and sane through monetary weather. Once you make that shift, you stop treating this conversation as a gold story. It becomes what it really is. A story about who understands that the world is already repricing money itself. If you ignore that, you may still feel clever for a while. You may feel patient. You may feel conservative. You may feel above the drama. And meanwhile, the ruler melts in your hand. That is how people get poorer without ever seeing a headline that says they lost. They did not lose in a dramatic crash. They lost in a long, polite misunderstanding of what cash was defending them against. I do not want that for you. So here's the question I want you to carry after this. Are you protecting your wealth from volatility, or are you protecting it from devaluation? Those are not the same assignment. One asks how much something wiggles. The other asks whether the unit itself is staying honest. In 2026, I care very much about that second question. I think the biggest reset is not coming in the future tense. People like to use "I think it is already happening" in the custody choices of serious institutions, in the reserve behavior of central banks, in the policy constraints of deficit, heavy governments, in the repricing of everyday life, and in the widening gap between what ordinary savers think cash is doing for them and what it is actually doing. That is why I called this the biggest reset. Not because the television told me to be dramatic, because when the ruler itself begins changing, everything measured by it becomes suspect. And if you can see that before most people do, you do not need to panic. You simply need to allocate like an adult. That is enough. In fact, that is almost always more than enough.